Troy Gayeski is Managing Director and Senior Portfolio Manager at SkyBridge Capital, and he joins us right here. And Troy, we're coming to the quarter end, and for a lot of companies, the fiscal year end as well. We've seen an incredible run from early October. Is this it? Have we used up all of our run up until now, and will the second half slowdown start to really take hold?
Yeah, it's difficult to say whenever it comes to predicting equity markets. I mean, for quite some time, we've been in this massive risk-on, risk-off world, right? So if you look back over the past 9 months, you had a significant sell-off of north of 20% in equities, followed by this almost magical 27, 28% rebound. Yeah. And so, when we step back, it's always difficult to handicap where equity markets go from here. We think you have much more predictive power over debt markets, which is one of the reasons we favor those today. So we would say net, you have implied volatility at extremely low levels. You've had a significant rally. So if anything, the trajectory of further increases will be much more shallow than it has been recently. We're not calling for a big pullback in the near term, but we do think the risk reward of being long equities in particular has faded dramatically over the past few months.
What about the unwind in treasuries?
Well, that's a great question. I mean, what we're trying to focus on now at SkyBridge Capital is either catch-up trades or things that need to correct themselves, right? And one of the
what does that mean? Just so we get a better idea.
Yeah, so a catch-up trade, for instance, would be you've had this massive rally in equities and massive rally in liquid risk assets. There are other less liquid assets that haven't caught up yet, such as lower quality high-yield bonds, right? Such as, say, small and mid-cap European equities. Another catch-up potential theme would be, why are treasury yields this low if we're not in a depression, right? I mean, if you look at the 5-year, for instance, right, it's about 1% now. If you go back to last year at this time, it was around 2%. No one's saying it's going from 1 to 2%, but if the economy is doing well and equities are truly valued, then that means treasury yields should be much higher than they are today.
So, Troy, if I'm hearing you correctly, it sounds like the position then, or the trade to put on, is short treasuries and it's long European equities. It's also long some of the European high yield. Is that right?
Well, I don't think you'd want both of those on at the same time, because if something if something did go wrong, you'd lose money on both of those risks. Right. But we're certainly looking now at various positions that have optionality to increasing rates if the economy's improvement is really true.
Well, then you talk about lower rated high yield bonds and European equities. Are you saying high yield space, U.S. high yield space and European equities aren't correlated, so you'd put both of those trades on?
No. So they're both correlated to risk assets. We would have a much stronger opinion on U.S. high yield bonds than we would on European equities, particularly small and mid cap, because that, again, is very difficult to handicap. But if you look at U.S. high yield bonds, particularly down in credit quality, like CCC bonds, for instance, they're still about 300 basis points wider than they were at their local tights last year before the crisis got going. The cash-on-cash yields are somewhere between 8 and 15%, depending on you were. So again, if the economy has strengthened as much as people think, if equity markets are accurate at where they're valued today, then that means over the next 3 to 6 months, you should have a significant catch-up between high-yield bonds, where they're priced today and where they were priced last March, for instance.
Now, help the viewers. Can you give us a couple examples, just some names so people can identify what
we don't talk about individual names, right. But if you look at home builders and some oil and gas companies that are more speculative, a lot of those, they're not the AIGs of the world, which kind of dominate those indices. They're more off-the-run names, and off-the-run names in cash bonds have actually lagged the on-the-run indices dramatically, which is typical in market rebounds. So that's one area that we think has.
If you can get your hands on those bonds.
Well, that's the problem. Well,
yeah.
See, for us, guys already own them, so we have the potential to invest more capital at those lower prices, and eventually if prices catch up, you have a mark-to-market gain. But if prices don't catch up, that's fine too, because you're still making a great yield and you're pretty confident that we're not going to have a recession at least tomorrow or the next quarter or probably the quarter after that.
What about mortgage-backed securities? It's obviously a focus area for you. Where are you falling in on those now?
Well, we still love mortgage-backed securities. I mean, it's still the most inefficient market by far. There's two main segments. One is the prepay sensitive, which has more to do with the fact that home prices have gone down so much and underwriting standards have tightened so much. The yields are still great. That's another catch-up trade. IO securities in particular have just started to move.
So in other words, people still hate mortgage backs. They still haven't got back in, which is why you call it a catch-up trade.
Correct. I mean, hate's a strong word. I would say that there's a tremendous amount of political uncertainty, and any time rules are changed, as they were last year with HARP 2, that causes people to step back and say, hey, you know what? We need to be paid more to own these bonds. As things stabilize and people start coming to grips with the new rules of the road, then these things tend to catch up over time.
At what point does the catch-up trade become a crowded trade?
Well, by definition, if it's a catch-up trade, it's not crowded yet, right? I mean, that would be
So
our.
I'm asking you to look into your crystal ball.
No. But we would say probably over the next 3 to 6 months. Again, the thing we like about things like this is if this rally is true, you have significant upside, right? If it's not, what's the big deal? You're not going to have much downside. In the meanwhile, you're collecting significant carry. Now, the other part of the mortgage market we like, of course, is the credit-sensitive market, which is Alt-A, option arm, subprime, which got hammered in 07 and 08.
So you like subprime as a long?
Well, the top of the capital structure we like. I mean, the loss-adjusted yields are still in the 8 to 12% range, which if you look at, where risk-free is, basically 0 and 2% at the 10-year point, it's kind of crazy when you think about it. And even if you run doomsday scenarios, you're probably break even. So that's another one with good risk-reward. And again, there's another catch-up trade because as liquidity continues to flow through markets, prices should continue to appreciate.
What's the biggest risk out there for you?
The biggest risk for us right now, the way we're positioned, that's local to how we're positioned, is some type of dramatic government action that further stimulates refinance activity, particularly in newer vintages in the agency market. The reason that we say that's our biggest risk is because we tend to be positioned differently than most of our competitors. We have a lot more risk in that space. So that's clearly something that if it goes wrong, we could lose money, whereas other guys would not.
All right. Thank you so much for joining us this morning.
Yeah, it's a pleasure to be here as always.
All right. Troy Gayeski, Managing Director and Senior Portfolio Manager at SkyBridge Capital.